Behavioral finance is a field of study that merges psychology with finance to better understand how emotional, cognitive, and social factors influence investors' decision-making processes. Unlike traditional finance theories, which assume that investors are rational and always make decisions that maximize their utility, behavioral finance acknowledges that humans often act irrationally. These irrational behaviors can lead to anomalies in the market, such as bubbles, crashes, and other market inefficiencies. Investor psychology, a subset of behavioral finance, delves into the mental processes and emotional states that drive investment decisions. Before starting, don't forget to like and subscribe to our channel The Financial Feed for more future updates. The foundation of behavioral finance emerged as a response to the limitations of classical finance theories, which rely heavily on the efficient market hypothesis, EMH. According to EMH, all available information is already reflected in asset prices, and it is impossible to consistently achieve higher returns than the market average without taking on additional risk. However, numerous market events, such as the dot-com bubble and the 2008 financial crisis, have demonstrated that markets are not always efficient and that psychological factors play a significant role in financial markets. One of the foundational concepts of behavioral finance is the idea that investors are not always rational actors. This departure from rationality can be attributed to several psychological biases that affect decision-making. By studying these biases, behavioral finance provides insights into why markets behave the way they do and how investors can avoid common pitfalls. Psychological biases in investing. Several psychological biases are commonly observed in investor behavior. These biases can lead to suboptimal decisions and contribute to market inefficiencies. Understanding these biases is crucial for both individual investors and financial professionals who seek to make better informed decisions. Overconfidence bias. Overconfidence bias refers to the tendency of individuals to overestimate their abilities, knowledge, and predictions about the future. In the context of investing, overconfident investors may believe they have superior information or skills, leading them to take on excessive risk or trade more frequently than is optimal. This behavior can result in lower returns and increased transaction costs. Overconfidence is particularly prevalent in bull markets when rising asset prices reinforce investors' belief in their abilities. However, during market downturns, overconfident investors are often caught off guard, leading to significant losses. Anchoring bias. Anchoring bias occurs when individuals rely too heavily on an initial piece of information, known as an anchor, when making decisions. In investing, this might manifest as an investor clinging to the purchase price of a stock as a reference point, even when new information suggests that the stock's value has changed. As a result, investors may hold on to losing investments for too long, hoping the price will return to the initial anchor. Herding behavior. Herding behavior refers to the tendency of individuals to mimic the actions of a larger group, often disregarding their own analysis or beliefs. In financial markets, herding can lead to the formation of asset bubbles, where prices are driven up by the collective actions of investors, rather than by underlying fundamentals. Herding is fueled by the fear of missing out, FOMO, and the desire for social validation. When investors see others making money in a particular asset or market, they may feel compelled to follow suit, even if they have reservations. This behavior can lead to irrational exuberance, as seen during the dot-com bubble, or panic selling during market crashes. Loss aversion. Loss aversion is a concept derived from prospect theory, which suggests that people experience the pain of losses more intensely than the pleasure of equivalent gains. In other words, the fear of losing money often outweighs the potential joy of making money. Loss aversion can lead investors to make conservative choices, such as holding onto cash instead of investing in potentially profitable opportunities. It can also result in the disposition effect, where investors hold onto losing investments in the hope of recouping their losses, while selling winning investments too quickly to lock in gains. Mental accounting refers to the tendency of individuals to categorize and treat money differently based on its source, purpose, or intended use. In investing, this can lead to irrational behavior, such as treating money from a bonus or inheritance as fun money that can be risked in speculative investments, while treating savings or salary as more sacrosanct. Mental accounting can also lead to suboptimal asset allocation, as investors might create mental buckets for different types of investments, rather than considering their overall portfolio in a holistic manner. This can result in a lack of diversification or an overly conservative or aggressive investment strategy. Confirmation bias is the tendency to seek out, interpret, and remember information in a way that confirms one's pre-existing beliefs or hypotheses. In investing, confirmation bias can lead investors to selectively focus on news or data that supports their investment decisions, while ignoring or downplaying information that contradicts them. This bias can create a self-reinforcing cycle, where investors become increasingly confident in their decisions, even in the face of mounting evidence to the contrary. As a result, confirmation bias can contribute to the persistence of market trends or the formation of bubbles. Recency bias is the tendency to give more weight to recent events or information when making decisions. In the context of investing, this bias can lead to an overemphasis on short-term market performance, rather than considering long-term trends or fundamentals. Availability heuristic. The availability heuristic is a mental shortcut that relies on immediate examples or information that come to mind when evaluating a situation or making a decision. In investing, this heuristic can lead to an over-reliance on readily available or easily recalled information, rather than conducting thorough research. Representativeness heuristic. The representativeness heuristic is a cognitive bias where individuals judge the likelihood of an event or outcome based on how similar it is to a particular prototype or stereotype. In investing, this bias can lead to the assumption that past performance is indicative of future results, even when there is no logical basis for such a belief. Investor behavior during market extremes. Behavioral finance provides valuable insights into how investors behave during periods of extreme market conditions, such as bubbles and crashes. These events often amplify the psychological biases that influence decision-making, leading to irrational behavior on a large scale. Market bubbles occur when asset prices are driven to unsustainable levels, often due to speculative behavior and the belief that prices will continue to rise indefinitely. Behavioral finance explains that bubbles are fueled by a combination of overconfidence, herding behavior, and confirmation bias. Investors may become convinced that this time is different, and that the traditional rules of valuation no longer apply. Market crashes are characterized by sudden and severe declines in asset prices, often triggered by a loss of confidence, economic shocks, or other external factors. During a crash, behavioral biases such as loss aversion, recency bias, and herding behavior can lead to panic selling and a cascade of losses. Loss aversion plays a significant role in market crashes, as investors become desperate to avoid further losses and may sell their holdings at any price. Recency bias can exacerbate the situation, as investors focus on the recent downturn and assume that prices will continue to fall. Herding behavior can lead to run on the market, where the actions of a few trigger a widespread sell-off. Behavioral finance and portfolio management. Behavioral finance has significant implications for portfolio management, as it challenges traditional approaches to asset allocation, risk management, and investment strategy. By incorporating insights from behavioral finance, investors can develop more robust and resilient portfolios that account for the psychological factors that influence decision-making. This is it for today's video. What do you think of our video? Comment below with your thoughts and let us know if there is any other videos you would like to see. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.